2014 was a remarkable year for the Irish commercial real estate market, both in terms of value improvements, but particularly in relation to transaction volumes, with transactions in almost all sectors up significantly year on year. Indeed, Irish commercial real estate was one of the best performing asset classes in the world in 2014. Over £4.5 billion of investment transactions were recorded, and over £21 billion of Irish loan sale activity was recorded in the 12-month period. The year passed in a haze of loan and asset sales, but remarkably, there were quite a number of developments over the course of the year, most significantly the decision by NAMA to accelerate their deleveraging programme. We had the ending of the capital gains tax waiver. We also had the formal adoption of the Strategic Development Zone, or SDZ, in Dublin Docklands, which will be very significant in the market over the next number of years. Pricing sharpened in line with what was seen right across Europe over the last 12 months, with yields converging and a very significant gap emerging between interest rate, bond rates and real estate returns. We saw an increased focus on retail investment, with quite a lot of shopping centres and retail parks being traded around the country and generating strong demand from a range of different types of buyers. We saw severe supply shortages in some sectors of the market, most notably the Dublin housing market and the Dublin office sector, which in turn led to very sizable rental and capital growth in many sectors of the market over the last 12 months. So all in all, 2014 marked a very pivotal year for the Irish commercial real estate market. So what is 2015 likely to bring? Our view is that we're going to see similar volumes of transactional activity being recorded in the market this year, both in terms of loans and asset sales. Another key trend for 2015 is a significant increase in the number of secondary retrades from many of the properties and assets that were sold over the last number of years coming back onto the market again. Another key trend for 2015 will be an increased focus on provincial and secondary assets, as the recovery that has been manifest in Dublin over recent years begins to spill out to other locations, with rental and capital growth coming through in many more sectors and locations. We're expecting to see strong volumes of activity in all of the occupier markets, office, industrial and retail, with a particular increase in activity in the retail sector of the market as the economic recovery takes hold. We're going to see some investors moving up the risk curve to some extent in 2015. Some investors clearly won't be able to rationalise pricing in the current market and will move up the risk curve into other alternative sectors. Some indeed may leave the jurisdiction, but equally we will continue to see new entrants coming into the market. We expect to see some investors focusing their attention on intensive asset management over the next 12 months. In terms of concerns for 2015, while we are encouraged by the volume of activity in the Irish domestic economy, we have to be mindful of macroeconomic threats that are looming on the horizon. We need to be very mindful of what's going on in the Eurozone. We need to be mindful of the bureaucracy that's involved for many occupiers in setting up new businesses and something that can threaten the market. We need to be very mindful of changes to tax law. The removal of the double Irish doesn't appear to have had any material impact on occupier activity to date, but we cannot remain complacent. Equally, we need to be mindful of changes to corporate tax law in Northern Ireland, which could have an impact on FDI flows into the Republic over the course of the next number of years. There's still a lot of uncertainty in the market around proposals by the Central Bank on mortgage lending. There's uncertainty what the new Planning Act that will be launched in 2015 will have, and the implications this might have for development. There's also issues around competitiveness. We've seen very rapid rental growth and capital value growth in the property market over recent times, and we need to ensure that we remain competitive relative to other jurisdictions so that we don't lose FDI. There's also some political concerns and a lot of questions being asked about political stability into the medium term, which we need to be mindful of. So while there are clouds on the horizon, the overall sense is that 2015 is set to be another very busy and strong year following the year just gone. And now moving to the retail sector of the Irish commercial property market. This sector saw phenomenal growth over the course of the last 12 months. On the back of a very strong economy domestically, we saw a notable improvement in consumer sentiment and in turn in retail sales. Many new entrants came into the market last year, including Massimo Dutti, Cass, Prima Donna, Nespresso, Michael Kors, the list goes on. Many retailers set up their first Irish stores over the last 12 months. The recovery has been firmly focused on the prime high streets, the major shopping centres and the major retail parks. It is very much a two-tier market, with Dublin seeing the main benefits so far. This year we saw Black Friday and Cyber Monday being introduced for the first time, which saw the Christmas trading period performing particularly well in the early part of November and the early part of December. It slowed down somewhat just before Christmas, but we saw bumper January sales. So the retail sector has firmly rebounded over the last 12 months, and we would expect to see this continuing over the course of 2015. We saw quite a bit of investor activity in the retail sector last year, with quite a lot of shopping centres and retail parks throughout the country being traded, and very strong demand from a range of different investors looking for these opportunities. This will continue in 2015, with several properties due to be launched, indeed over the coming weeks and months. We also expect to see intensive asset management of retail stock over the next 12 months, as many of the buyers embark on redevelopment and refurbishment programmes. Indeed, many of the schemes such as Liffey Valley Shopping Centre, The Square in Tala, Kildare Outlet Village are due to build extensions in 2015, while other schemes such as Merchants Quay in Cork are due to start intensive redevelopment projects. Brown Thomas in Dublin is due to undergo a €5 million revamp. 2014 saw some rental growth in the retail sector of the market, predominantly in the Dublin market. We would expect to see this starting to filter out into other locations over the course of 2015, with many provincial schemes beginning to see the first signs of rental growth coming through. In addition to rental growth, we also expect to see some improvement in lease terms in the retail sector this year, with many 10 and 15-year leases now being negotiated. And outside of Dublin, where temporary licence agreements were the norm up until now, we're beginning to see short-term leases being agreed. We would expect to see this continuing to firm up over the course of the next 12 months. We're also going to see in 2015 the first rent reviews coming through under the legislation that came through in 2010, introducing upwards and downwards rent review clauses, which will be an interesting one to watch. Another key trend for 2015, which has been experienced right across Europe at the moment, is further convergence between physical retailing and online retailing. Many Irish retailers will develop their online presence further in 2015, while many of them will begin to roll out a click and collect model. So all in all, a very, very strong year for the retail sector is envisaged. And now moving to the office sector. 2014 was a record year for the Dublin office market, with over 225,000 square metres of take-up achieved, which is considerably above the 160,000 square metre 10-year annual average for the city. There were over 200 leasing transactions concluded in the market, and quite a bit of the activity came from technology companies pre-booking accommodation, knowing that there is a scarcity of stock out there. Over 2015, there are some potential threats to foreign direct investment, not least changes to the Double Irish Agreement last year, which may have an impact on foreign direct investment flows into the country over the medium term. Equally, we need to be mindful of changes to tax law in Northern Ireland, which could potentially see some FDI going to Northern Ireland as opposed to the Republic in due course. Much of the activity in the office sector over recent years has been as a result of very strong flows of FDI into the country. So we would advocate government spending a lot more time supporting SME and Indigenous sector so that we don't become overly reliant on FDI. The scarcity of stock in the Dublin office market is unfortunately going to be the big challenge for 2015. There are severe shortages, particularly of Grade A stock in the Dublin 2-4 catchment. There's some planning applications coming into the system, and there is some stock under construction at present, but it will be some time before this is deliverable, and even then, pre-letting activity could remove this from the system. So as a result, there is going to be continued scarcity. The problem is going to get worse before it gets better. And ultimately, we're going to see further rent rises over the course of the next 12 months. it is not inconceivable that prime rents in Dublin 2-4 could hit €55 per square foot over the course of the next 12 months. It is inevitable that you will see many occupiers focusing on fringe locations and indeed suburban locations, particularly those that are cost conscious. So we would expect to see an increase in demand for suburban offices over the course of the next 12 months, and equally increased demand for Georgian properties over the next 12 months. Competitiveness is the main issue that we need to remain focused on. We don't want Dublin and indeed Ireland to be overpriced relative to other jurisdictions. So all in all, 2015 looks set to be a very strong year for the Dublin office sector, with the only fly in the ointment being a scarcity of prime stock to satisfy the volume of demand coming through. And now moving to the industrial and logistics sector of the market. In the early part of 2014, take-up in this particular sector was somewhat disappointing. However, in the second half of the year, we saw bumper take-up, bringing total take-up in the Dublin industrial sector to over 325,000 square metres in the 12-month period, up 10% on the previous year. We think that the supply of good quality stock in this sector will dwindle further over the course of the next 12 months as occupiers continue to take space, with data centres, biopharmaceutical, food manufacturing companies being the most prevalent. Rents grew to some extent over the course of the last 12 months, but are expected to rise further in 2015. They start the year at approximately €65 per square metre, but are likely to increase to €75 per square metre over the course of the next 12 months. However, despite these rent increases, development will not be feasible in this sector at those sort of rental values. So we're not expecting to see any speculative development emerging over the next 12 months. We will, however, see some design and build projects being initiated. Some occupiers and developers are focusing on acquiring land, with sites around the M50 that are well serviced being in strong demand at the moment from developers hoping to develop industrial accommodation in due course. We're also seeing quite a lot of appetite for industrial investment opportunities as many investors move up the risk curve and look for higher yielding diversification opportunities. The challenge will, however, be to find good quality industrial investment product. That said, in general, we're expecting quite a lot of secondary trading to happen in the market this year, and that may well give rise to opportunities for industrial properties. Prime yields for industrial properties have the potential to contract further over the next 12 months. They're starting the year at approximately 6.75%, but have the potential to contract by up to 75 basis points to 6% by year end. So against a backdrop of strong domestic economic activities, which should see growth in indigenous activity in this sector in 2015, we're very confident for the prospects for the industrial and logistics sector in 2015. So now moving to the investment sector of the market. This sector saw phenomenal activity last year, with over €4.5 billion of assets with a value of over €1 million in value traded, and a phenomenal €21 billion of loan sale activity. The buyers for both were quite different, with the Irish REITs and domestic institutions particularly active in the acquisition of assets, with a lot of the private equity investors more focused on loan sale activity. We would expect to see continued activity both in terms of loan sales and asset sales in 2015 as NAMA and the various banks continue their process of deleveraging. We also expect to see a notable increase in the volume of secondary trades, which will bring more stock to the market. There is potential for yields to contract further over the next 12 months by up to at least 50 basis points and potentially more in the industrial sector of the market. One thing that we're likely to see in 2015 is a growing divergence between the various buyers in the market, both in terms of what they're looking for and their focus of activity. Some investors will not be able to justify current pricing and may decide to move to other geographies or other asset classes. Other investors will focus their attentions in 2015 on intensive asset management programs. Others will move up the risk curve into the development space or potentially into the provision of forward funding. There's no doubt that some investors who came into the market a number of years ago may start to leave now and go to other jurisdictions. However, we continue to see new entrants to the market, replacing that demand and appetite. One of the key trends in 2014 was a notable increase in the volume of retail investment being traded, and that's something that we would expect to see continuing again in 2015. We also expect to see investors moving into other non-mainstream sectors, such as hotel investment, student accommodation, and increasingly multi-family residential investment, which is an asset class in its own right at the moment. One of the key topics in 2015 will be the relative pricing of real estate. Certainly in a very low interest rate and low bond rate environment, real estate investment looks particularly attractive. But we need to also focus on the fundamentals and the bricks and mortar behind that real estate. So we're looking at a very, very active and busy year in the investment sector again in 2015. So now to the development land sector of the market. 2014 saw a huge amount of development land being traded right around the country. We saw a record volume of sales, over 116 individual transactions, totaling over 674 million, which is more than 3 times the volume traded in the previous 12 months. Much of the demand for land was driven by a scarcity, particularly in the Dublin housing market and the Dublin office sector. We saw land values increasing on the back of that. So what will 2015 bring? The likelihood is that we're going to see an increased volume of land being traded, with continued deleveraging from NAMA and the various banks. What we don't know at this juncture if any major land banks will be brought to the market, as we saw with Project Cherry last year. Other than that very large land transaction, much of what traded in 2014 comprised relatively small parcels of land. But there is certainly a growing appetite for larger land banks, so it remains to be seen if they will come to the market and be traded this year. As rents and capital values have increased over the last 12 months, the feasibility of development has been improving all of the time, and that will continue to be the case over the course of the next 12 months. However, there are clouds on the horizon in the development sector. There's still a lot of uncertainty, particularly around the area of the central bank proposals on mortgage lending, the introduction of the Planning Act, which will see the introduction of a vacant site levy, and significant changes to existing social and affordable housing provisions. This uncertainty really needs to be cleared up to give developers the comfort to go on site and start developing the much needed accommodation, particularly in the Dublin housing sector and in the Dublin office market. The provision of funding is another issue. While there is funding available from private equity providers, we really need the traditional banks to start providing working capital to enable development to commence at the pace needed over the next 12 months. So all in all, a very, very busy year is expected. A lot of deleveraging will happen. And just as we've seen in many other sectors of the market, we expect to see an increase in the volume of secondary trades of land that was purchased as part of loan books and asset portfolios over the last number of years. So now to the hotel and pub sector of the market. Again, this is a sector where we saw a phenomenal volume of deleveraging over the last 12 months. In total, over 63 hotels were sold across the country in 2014, compared to 33 in the previous year. Over 340 million was spent on these hotels, which is a very significant increase on the previous year. In addition, a further 355 million of hotels transactions were in legals at year end, suggesting that the volume of activity will be even stronger in 2015. Over 40% of the spend on these hotels emanated from Irish buyers, which is encouraging. In addition to deleveraging from NAMA and the various banks, we expect to see a lot of secondary trades of hotels purchased over recent years, and many more consensual sales in a sector where much of the activity over recent years has been distressed. We expect to see more hotels trading as loans as opposed to asset sales this year, and we also expect to see a notable increase in the number of portfolios of hotels that are brought to the market and sold. The value of hotels has increased over the last number of years because the performance of hotels is very much dependent on their trading performance. And against a positive economic backdrop, a 9% increase in tourist numbers year on year, and the retention of the 9% VAT rate, we have seen the domestic hotel sector market improving. 2015 will also see the first signs of new development of hotels happening in the Dublin market. There are several hotel projects in the planning process, and we will see development commencing. However, this will be limited to Dublin, with no new hotel development envisaged anywhere else in the country. We're also likely to see some new legislation coming in around the minimum size of hotel rooms, which will have implications for the Dublin market and may see some new budget accommodation coming on stream as a result. We also expect to see an increase in the availability of traditional bank funding for hotel projects over the next 12 months. A very similar picture was envisaged or experienced in the Dublin pub sector in 2014. We had over 38 pubs trading in Dublin with a total capital value combined of over 44 million, compared to 19 trades in the previous year. We also had a significant number of pub properties in legals at year-end, which will boost Q1 2015. The ending of the capital gains tax waiver on the 31st of December certainly had an impact in this particular sector of the market, with a flurry to get transactions completed by year-end. Unlike the hotel sector, we're not yet seeing consensual sales in the pub market, with many of the properties that are being brought to the sale coming from distressed situations. Again, unlike the hotel sector, where many of the properties that are likely to trade this year will form part of portfolios, much of what will be sold in pubs will comprise individual pub sales. We expect to see some of the owners of multiple properties coming back out and buying additional properties this year and building up their portfolios. In many cases, these buyers will be funded by international backers and international funders. A key change in the pub sector over recent years is that the purchasers of pubs are now solely focused on the underlying business and the profitability of that business, as opposed to focusing on alternative use values. We've seen an increased focus on the food and drink element of these business. Ultimately, profitability affects value, and in that respect, it will be interesting to see what effect Wetherspoons, who intend to buy quite a lot of pubs in the Irish market over the next 12 months, what effect that will have for the pub sector in the short to medium term. The demand for pub licences is expected to remain relatively weak over the next 12 months, with pub licences expected to trade for somewhere in the order of €55,000. All in all, we're expecting a very strong volume of activity in the pub sector again in 2015, very strong appetite from buyers, and quite a lot of deleveraging still to come from NAMA and various banks and financial institutions.